What just hit the markets isn't just a rally, it's a shockwave. In the span of 48 hours, gold blasted from $4,900 to over $5,200, silver exploded from $88 to $104, trading volumes spiked to levels not seen since the 2011 supercycle, and the total market capitalization of the precious metals universe expanded by an astonishing $5 trillion. Exchange order books throttled, volatility indices spiked, and traders on both sides of the tape were left scrambling. Central banks that were once net sellers are now aggressively accumulating gold reserves, aggressively responding to currency instability and geopolitical fractures. Today we break down what's driving this historic move, why it matters, whether it can continue, and what you and institutional players are really watching next. Let's unpack the price action first, because it's nothing short of dramatic. Massive moves in price and volume. Gold, which had been range-bound between approximately $4,900 and $5,100, broke sharply through resistance to $5,200 plus on massive volume. Silver, historically more volatile, slid to a low near $88, but buyers stepped in hard, pushing it to $104, a gain of nearly 18% in 2 days. Trading volumes exploded, COMEX open interest surged by over 22%, and bid-ask spreads widened sharply as liquidity frayed in key futures contracts. Market cap expansion. The implied market cap for gold and silver, combining futures, ETFs and estimated physical holdings, expanded by about $5 trillion, a number that would make it one of the largest liquidity events in commodities history. Central bank behavior. For the first time in nearly a decade, several emerging market central banks reported net increases in gold purchases quarter over quarter. Some had even tapped strategic reserves previously. This wasn't a whisper, it was a shout. To understand why this is happening, you've got to look upstream into the very structure of how metals trade and where the pressures are building. Futures markets, supply and positioning in the futures arena, manage money, spec funds have been covering shorts aggressively. Open interest rallied even as prices broke out. That tells us new participants are entering long positions, not just short sellers capitulating. The Commitments of Traders report shows institutional money flipping net long in gold for the first time this year. Technically, that's a market that's not just bouncing, it's rotating into a new regime. Physical supply constraints on the physical side. Inventory at major exchange warehouses, especially COMEX and LBMA locations, has been drawing down. Premiums between spot and physical delivery have widened, particularly in Europe and Asia, signaling real demand outpacing available supply. This is critical because it creates pressure on the delivery mechanics of supposedly fungible contracts. Technical levels. Gold's former resistance at $5,100 now appears to be a new support level. Silver's previous ceiling around $95-98 has been decisively breached. These kinds of breakouts rarely happen without underlying structural shifts. Institutional positioning. Hedge funds and wealth managers are increasingly treating metals as macro hedges, not merely commodities. Many insurance desks report rising interest in volatility hedges tied to gold futures and options, another hint that players anticipate future instability. Now let's connect the dots with the broader global macro backdrop. Federal Reserve policy. Although many expected a pause or pivot from the Fed, recent commentary from policymakers has been hawkish. Real interest rates remain elevated, diminishing the opportunity cost of holding non-yielding assets like gold, but increasing fear of tighter credit conditions ahead. And that paradox, gold rising even as rates stay high, tells us something important. This isn't just inflation hedging, this is risk hedging. Inflation dynamics. Consumer price data remains sticky in several major economies. Headline inflation may be moderating, but core inflation refuses to fall quickly, feeding uncertainty among global fixed-income investors. This ambiguity fuels demand for stores of value. Geopolitical stress. We've seen heightened tensions in multiple theaters of conflict, disruptions in key supply routes like the Red Sea and Baltic corridors, and trade realignments as nations diversify away from traditional partners. When global confidence fractures, gold and silver historically benefit. Currency instability. Major reserve currencies, especially the US dollar, are showing early signs of stress. FX volatility is elevated. Some emerging markets are witnessing sharp drawdowns in their local currencies. Central banks are turning to hard assets as a hedge against currency devaluation. This global dance between monetary policy and geopolitical risk is fundamentally reshaping metals demand. This is where the narrative gets nuanced. Paper markets. When we talk about the paper market, we mean futures, options, ETFs, and other derivatives. Highly liquid, often leveraged and used for hedging or speculative positioning. Moves here can be rapid, but they don't necessarily reflect supply in the physical world. Physical markets. This includes bars, coins, allocated vault holdings, and actual delivery of metal. Physical markets are less liquid and more sensitive to supply chain bottlenecks and transportation constraints. Why the divergence matters? What we're seeing now is a decoupling. Paper gold and silver prices are reacting to macro hedging and flow dynamics. Physical gold and silver inventories are tightening. That gap, the basis between paper and physical, can lead to forced deliveries, pricing dislocations, and higher premiums for real metal. In other words, the market is signaling something deeper than a simple price move. It's signaling structural stress. To make sense of now, it helps to look at then. This situation bears resemblance to two major historical inflection points. 1. The 1970s precious metals supercycle inflation spiked. The dollar weakened. Geopolitical unrest was pervasive. Back then, gold went from under $100 to over $800 in real terms, a massive repricing tied to monetary regime shifts. 2. The 2010-2011 rally silver peaked near $50. Gold approached $1,900. What drove that? Easy money, sovereign debt fears, quantitative easing. But what's different now is that rates are not ultra low and inflation isn't collapsing. We're in a stressful macro plateau, not just a cheap money cycle. That's unique. Let's lay out both paths clearly, bearish and bullish. Bearish scenario: prices could fall if central banks pivot aggressively to tightening, tamping inflation expectations and strengthening the dollar. Economic slowdown softens risk appetite, reducing safe haven buying as stocks restabilize. Physical supply normalizes, with mining output recovering faster than expected. Paper markets unwind positions without contagion into physical inventories. If all of these come together, we could see a retracement potentially back toward $4,800, $5,000 gold, and $88.95 silver. That doesn't mean the rally is over. It means the market adjusts, digests, and resets. Bullish scenario: a major rally could be triggered by escalating geopolitical risk, war, sanctions, banking stress, accelerating currency debasement, especially from major reserve holders. Breakdowns in credit markets, prompting sharp demand for hard assets. Retail and institutional flows seeking safety, causing squeezes in both paper and physical markets. In that case, new all-time highs become realistic, potentially $5, 500 plus gold, and $120 plus silver, with velocity driven by real demand and fundamental tightness. For traders and macro investors alike, these are the must-watch data points. Gold support, $5,100, $5,000, resistance, $5,300, $5,450, silver support, $98, $92, resistance, $110, $120, ratios gold-silver ratio. If it compresses back toward historical norms, it signals strength in silver versus gold. Inventories COMEX and LBMA warehouse levels, ETF holdings, GLD, SLV, physical premiums, delivery premiums in key markets like Singapore, Zurich, and Shanghai macro data, CPI, PPI Fed rate decisions, FX volatility indices. Every one of these tells a piece of the bigger story. Let's break this down into 3 core points. This isn't a simple bounce. It's a structural repricing across paper and physical markets. Global macro risk, not just inflation, is driving demand in ways we haven't seen in years. Key levels and inventory signals matter because the market's next move depends on both psychology and supply mechanics. So, what does all of this mean for you? This isn't a clickbait headline. It's a macro event, a confluence of price discovery, institutional flows, central bank strategies, and real global risk. The markets are telling us something important. Uncertainty breeds demand for hard assets. When confidence in paper claims falters, stay analytical. Watch the data, not the noise. And as always, think independently. The next few weeks could tell us whether this is a prelude to a new regime, or a momentary shock in a longer narrative. Thanks for watching. If you found this breakdown useful, hit like, subscribe, and turn on notifications, because we'll be tracking this story as it unfolds.